So we see a ton of people get ripped off when they're getting whole life insurance policies under the concept of bank on yourself or infinite banking. And often what clients express is I was interested in a whole life insurance policy and I expressed to my agent I wanted to have as much cash value as possible. But then when I got that policy, I found out that I could have had the same product with the same insurance company and my out of pocket would have been exactly the same. And I would have had another 40 to 50% in cash value compared to what I was sold. I'll give a quick example. What we see all the time is someone would get a whole life insurance policy. They pay, call it $30,000 per year. In the first year, their cash value is $15,000 or $16,000. And as they keep paying $30,000 year in and year out, it's not until year 7 or 8 that they finally get their money back. That's a lost opportunity cost all of those years. The reason why that's the case is because of that $30,000 that they're paying, about $12,000 is directed toward the base premium. The rest goes toward our paid up additions rider. If you're new to this, the base premium satisfies life insurance first with a traditional whole life insurance product and typically gives me zero cash value in the first year and sometimes even in the second year. So what we see a lot of times is clients are interested in whole life insurance because they want to practice infinite banking, which revolves around the idea of taking a loan against a policy, and when you borrow against it, your cash value keeps on compounding. That's why people are attracted to it. But then they're sold policies that don't have as much cash value as possible. So if the goal is to get a whole life insurance policy with as much cash value as possible, here's exactly what I would do. If you're paying the same $30,000 per year, instead of having a $12,000 base premium, which might give you $16,000 or so in first year cash value, I would set that minimum base premium as low as the insurance company will allow. And with the top companies, that's often right around 10%, which would be $3,000 in this particular case. So if I'm paying $30K and my minimum premium is $3,000, my first year cash value is now all of a sudden somewhere between $26,000 and $27,000. I get my money back somewhere between 3 and 4 years. If life happens and I want to pay the minimum, it's only $3,000 instead of $12,000. And when I compare that policy with the $12,000 premium example, I've got more cash value in the beginning, more cash value long term, and when I look at the guarantees, I've got more indefinitely. That's what I would do to set up a policy to have as much cash value as possible. Hope this helps.